you will incur more responsibility, of course. If the faucet breaks, if you have a leaky faucet, or if your toilet overflows, that is all your responsibility. And that's something that you will have to maintain. Of course, if you don't take care of your home, or if you live in a neighborhood which may have gone through some changes and the neighborhood is kind of going down, then you might experience a little bit of depreciation of your home. Another thing that I also like to bring out to people who may be on this home buying journey is that it may be more difficult for you to move. Once you purchase a home, you likely have invested all that you have into obtaining that home in terms of down payments and everything. And you can't control who moves in across the street from you or who moves in next door. It could be the girl that bullied you in high school, and you don't want to live next door to her, but if she moves in, it may be a little difficult to move out. So those are just some things that I want you to keep in mind. The next thing that I want you to think about before you start looking at homes and just going out and getting the ball rolling concerning purchasing a home is preparing your credit. This is one of the most important things that you're going to experience in your home buying journey, is talking about credit and having different credit discussions with the mortgage lender. So the first thing to do, all of these tips, kind of make note of those, because all of these are going to play a significant role in preparing your credit. So the first thing that you want to do is make sure, if you're not already paying your debts on time, is to make sure that you pay your debts on time. Paying your bills on time contributes 35% to developing your credit score. So you want to make sure that you get those bills paid on time. Also, keeping your credit card and loan balances low, that attributes to about 30% of how your credit score is calculated. So make sure that you are not maxing out your credit cards. If you've got a credit card with a $5,000 limit on it or a $500 limit on it, you certainly do not want to be at the max. That can cause your credit score to drop over sometimes almost 100 points or more. So keep that in mind. Another thing is, I get asked this question all the time. There are people out there will tell you, oh, if you don't have credit, you may need to establish some new credit. And that may be true. It does help to have new credit. However, you want to make sure that you keep those new debts for at least 6 months to a year before you pay them off. Slow and steady wins the race, as they always say. You want to pay them. It takes discipline from you to pay those bills each month on time. Anyone can get a stimulus check and get it today and then go pay the loan off tomorrow and say, oh, I've paid the loan off early. Well, that's not really helping your credit. Lenders want to know that you are able to handle a debt over time and that you've got the discipline to do that. All right. Step number 4 is stay away from inquiries for new credit. So if you're looking for a home, you don't need to be out shopping for a 4-wheeler or a new car or just new toys or new credit cards or going on shopping sprees around the house. You need to make sure that you are really serious about purchasing that home, because one thing about it, when you sit before a mortgage lender, they're going to see all of those inquiries on your credit report. The main thing is it's going to reduce your credit score potentially. And then the other thing is the mortgage lender is going to probably not look at you, take you seriously if they see that you're also shopping for a new 4-wheeler or a new car. And finally, maintain a healthy credit mix. Well, you might say, well, what is a credit mix? Well, let me tell you. A credit mix is just having the right types of credit, a combination of good forms of credit. So there are 2 that I'd like to bring to your attention. One type of credit is revolving credit. And revolving credit simply refers to a credit card or a line of credit. You want to make sure that you're paying that credit card on time and that you're keeping your balance below 30% of the available credit limit. Now, I'll take it even a step further. If you've got a credit card, make sure, try to strive to keep your balance, your credit card balance, as close to zero as possible. That's kind of my rule, and that'll help you move along a little faster. And then the second type of credit that you that's a ingredient in the healthy credit mix is installment credit. Installment credit simply refers to bills that you pay in installments, like your auto loan. You're given a certain amount of money up front, and then you pay it back in installments. So an auto loan, a personal loan, even a student loan is an example of installment credit. Keep one of each, at least one of each of those types of credit, pay them well, pay them on time, and I guarantee in about 3 to 6 months, you'll begin to see a difference in your credit score, a positive change in your credit score. So the next thing that you can do, some of you may have already been familiar with paying your bills on time and all of that. And for those, whether you are or not, I stress that you get a copy of your credit report and examine your credit. And when you examine it, here are some things that you might look for. You're going to check your credit report for accuracy and make sure that everything that you're paying is recorded as it should be. Sometimes some companies do not report all of your information as they should. Some companies don't report to the credit bureau at all. So that's another thing that you might want to check with the lender and make sure that they're reporting your payments. If you're making good payments, you certainly want them to be there. Sometimes people will look into getting a mortgage. They'll get to the mortgage table and they're applying and they feel like everything is good, and they'll find that a doctor bill, a medical bill, has some kind of way slipped on their credit report, something that they may not have been aware of. So those are the types of things that you're checking for. You're also checking for inaccuracies. You're checking for things that may not be accurate, and those things you can certainly dispute. Another thing that you'll check for is your credit score. I always advise my clients to strive for a 640 credit score or above. This will ensure that you can qualify for the best rates and the best options concerning purchasing a new home. You can certainly purchase a home with a credit score less than 640. It just depends on the mortgage lender and the company that you're working with. But if you want to get the best options, you certainly want your credit score to be as high as possible. Another thing that I stress is that you look for opportunities to reduce your debt. So this will come up later in the presentation. We'll talk about debt to income, but you certainly want to have as few credit accounts as possible, because that is going to help you be able to purchase more home. The fewer debts that you have, the larger the mortgage amount that you may be approved for, okay? And of course, all of these things are really important. And if you have some questions about some of them, you're not kind of not clear on them, check with a financial counselor or a banker at your local bank or credit union and ask for some guidance on how to prepare your credit for a mortgage. All right, so now that we've talked all about credit and things like that, here's just a home buying checklist. Here are some things that I want you just to review. You feel free to take a snapshot of any of these slides as we go through, and also feel free to ask questions. Put them in the Q&A box. I'll be happy to answer any questions after the presentation. So here are just some things that you'll want to start getting your hands on during the year before you look to purchase a home. And one of those is your tax returns for the last 2 years and your W-2 forms for the last 2 years, most recent paycheck stubs, employment verification. If you're self-employed, you'll certainly want to gather all of those profit and loss statements and things like that. Driver's license and social security card, you should have that readily available. And of course, bank account statements. Mortgage companies will want to review your bank account statements. Sometimes it's for the last 30 days. I have seen cases where they have requested bank statements for the last 6 months. Of course, if you have filed for divorce or have recently divorced, you'll want to have all of those documents readily available in case you are asked about those. All right, so debt to income ratios. I did mention that a little bit earlier. I told you to try to keep your debts as low as possible and look at some ways to reduce debt if you have a lot. So this is one of the reasons why it's called debt to income. And debt to income in a nutshell is your income, your debts divided into your income. And they come out with a ratio that tells the mortgage companies basically how much you can afford. So the more debts you have, the lower the amount of home that you will be able to afford. The fewer debts you have, the larger the amount that you will be able to afford. It doesn't mean that you want to use all of that, but you certainly don't want to be in a situation where all of your income has been absorbed by your debts. So in other words, if you make $2,000 a month, you should not be spending $2,000 a month in debts because your debt to income will be all maxed out. So make sure that you are keeping your balances as low as possible. All right, this is a question that I get asked about a lot and we discuss a lot is pre-qualification versus pre-approval. Those are terms that you may hear along the journey of your home buying journey, and I don't want you to be confused about those because they are very different. They're similar, but very different. So the first one is pre-qualification. Pre-qualification is just the first steps. It's the first steps in the mortgage approval process. It simply means that the lender believes that you would be likely approved for a loan of a certain amount. So you submit an application, like a pre-qualification application. They'll take a look at your credit score and kind of look at how you handle your credit. If you're handling your credit in a good way, you've got a good, strong credit score, then most companies will pre-qualify you. Now, keep in mind, they have not yet gotten any type of income verification. They have not gotten your employment verification or your income tax returns. They're simply looking at, is your credit in a position where it will be able to support a mortgage? And so if you are able to get pre-qualified, that's a really good thing, but it gives you an opportunity in the pre-qualification stage to make some adjustments if you need to on your credit and get you exactly where you need to be. So pre-approval is different because in this stage, the lender will likely provide you with a commitment in writing that says, Mary has been approved for $150,000 to purchase a home. So this gives you the go-ahead that you need to get out there and hire a, really get the ball rolling. Well, actually in pre-qualification and pre-approval, you can really get a lender in, a real estate agent involved and kind of get the ball rolling. So let's talk about your financial responsibilities concerning purchasing a home. It starts way before the first mortgage payment comes into play. So let's talk about reserve. That means having at least 2 to 3 months of mortgage payment saved up in your savings account. The lender will want to see that. That shows responsibility and kind of discipline on your part. Will you be able to afford? How serious are you in applying for this home and getting approved? So in most cases, this money cannot be borrowed. The rules and laws change all the time. I know a long time ago, you were able to borrow the money maybe from a parent or get it, obtain it as a gift from a parent. So with your mortgage company, they will explain to you all of the ins and outs of that. Most of the time they will allow a financial gift, but not a loan. So they're going to be upfront fees, attorney fees, and insurance, appraisals, and all of that kind of thing. So make sure that you're saving the maximum amount of money that you can to prepare for your financial responsibility. In terms of down payment, you're going to need to save around 10 to 20% of the home's purchase price in order to move forward with your mortgage pre-approval. The lender is going to want to see that in your bank account. Now, if you are looking into something like a rural development loan, those generally, they require 0% down in most cases. So it just kind of depends on where you're looking to move and what type of loan you're going to take out. But look at saving some money for that down payment. Also, closing costs. Closing costs are around 3 to 5% of the purchase price of the home. Sometimes sellers will contribute this amount. You know, they can write it into the contract, but it just depends on your loan type and your lender and your seller. All right, so there are various different types of loan, mortgage loan types, and I've got them listed here. We will go briefly through those types of mortgages. So the first type of mortgage is a mortgage that is a really good type of mortgage. It's called a fixed rate mortgage. And it's just as the name implies, the interest rate does not change over the life of the loan. So if you're given a 3% interest rate, that's what it's going to be in 30 years from now. The interest rate is still going to be 3%. I'm sorry, not 30, 3%. And the terms of fixed rate mortgages, they range anywhere from 15 to 30 years. It just depends on how you need your payment structured and what you're looking to pay. All right, the next type is an adjustable rate mortgage. This is kind of a tricky type of mortgage. Typically in adjustable rate mortgages, you know, it's kind of linked to the economic index, and it depends on how things are going out there, but your payments could increase or decrease over time depending on the economy. I don't really recommend adjustable rate mortgages just because of that, because when you move into a home, you want to know if your payment is $600 per month, you want to make sure that it kind of stays at $600. It will be really bad, and I've seen it happen where someone may purchase a home at $600 or $700 per month, and then the economy isn't doing so good, so then their payments increase to maybe $1,100 or $1,200 per month, and that could really wreak havoc upon a family. All right, the next type of loan is called a conventional loan. So any mortgage that is not guaranteed or insured by the federal government is considered a conventional loan. You see these types of loans at banks and credit unions. They're kind of like private loans that the bank or credit union may grant to you. They are not backed by the government. So the rate could be a little higher. All right, the FHA loan. This is a loan that was created to make home ownership more easy and accessible for consumers. So it is administered by the Department of Housing and Urban Development. So it's a government-backed loan. This is one of the easy type of loans to get into, especially if you're a first-time homeowner. This is going to be something that you may want to look more deeply into. Of course, if there are any veterans out there, anyone who has served in the military, then you may already know about a VA loan. These are offered to military employees and former military employees for they offer 100% of residential loans for purchase and refinance to assist qualified veterans. This is a very good loan. If you qualify for a VA loan, this is something that I advise you to look into. They have a lot of, I don't want to get into a lot of the ins and outs of it, but they do have a lot of rules and programs and things that they can kind of really help you to get into that type of loan. All right, rural development loans. This is something that I mentioned before. Rural development loans, typically you are able to move into this type of loan with little to no down payment. Of course, just as the name implies, it is set aside for rural development. So that means outside of the city limits. And you will be surprised once you get to the point where you're able to get with a real estate agent, even here in Shreveport and Bossier. Some areas of Shreveport and Bossier and even DeSoto Parish and some of the surrounding areas, you will be surprised at some of the neighborhoods that qualify for rural development. It doesn't have to be a farm, you know, with cows and horses and hay and all of that. It could very well be something right here in the area that you're comfortable with, somewhere where you're comfortable moving, And you may be able to get into that home with 100% financing with no down payment. All right, and this just kind of gives more information about the rural development loan. Of course, it's a 30-year fixed rate, a 30-year fixed mortgage, which is good because you want a fixed rate and a fixed rate on it, and then you've got lower interest rates. All right. So now that we've learned about the credit, we've learned about the different types of loans that you can shop for, let's talk about shopping for a home. So these are some things that I'd like for you to consider. Many times people go out there, they get approved and they go out and it's like, oh, I like that house right there. And they purchase it and then they realize, oh my gosh, this home doesn't have enough closet space, or it doesn't have a garage, or the backyard isn't big enough for our children to play in. So let's think about some of these. Feel free to take a snapshot of this page and let's just kind of go through some of them. So the number of bedrooms and bathrooms. Have you ever been in a home with maybe one bathroom and you see the family is beginning to grow and they've got a lot of girls, and then it's going to be kind of tight trying to share that bathroom with a bunch of ladies or little girls in the house. So think about that. Closet and storage space. If you have a lot of shoes or a lot of things, or crafting, a lot of things that you like to do, make sure that you've got adequate storage space in that home when you're looking for a home. Pools, upgrades to the home. How far is this home from my, how long is the distance from work to home? Do you want to, live within 5 minutes of your job, or do you want to live a little bit further out? Are you okay with that? Also, check the schools in the area, and then certainly check the crime statistics in the area to make sure that this is somewhere where you want to live. All right, we get questions a lot about purchasing foreclosures, and it's kind of a popular thing. If you're like me, you probably watch House Hunters or Flip This House or some of the programs that pertain to home improvement. And all I can say is use caution. For purchasing a foreclosure can be a very good thing. You're likely able to purchase a home, unfortunately, where someone else had to lose their home. You may be able to purchase it for a good price. However, use caution because most of those homes are sold as is. And if you are a handy person, or if your spouse is a handy person, this may be a really good option for you if you know how to fix up a home. But typically, these types of loans will not qualify for an FHA loan. This is going to have to be a conventional loan, so check with your mortgage lender or your banker before doing so. All right, and so this just talks a little bit more about purchasing a foreclosure. There are a lot of websites out there. There are some specific lenders out here in Shreveport, or specific real estate agencies that deal with foreclosures. So if that's something that you're interested in, certainly reach out to some of them and they will be able to help you. All right, so here is another type of home that you can consider. Typically people consider single family homes in the city, or like we just talked about, the foreclosure. But here's another type of home that you may bring you a lot of happiness, and that's a manufactured home. Manufactured homes are also known as mobile homes, and we're familiar with those. Living in Shreveport, you see them a lot. Very, very nice homes. Some of them come in single wide, double wide, or even triple wide. And a lot of them now reflect single family homes. They look just like single family homes. However, they're on a chassis where they can be moved if needed. And these homes can range anywhere. I've seen them range from maybe $20,000 for a small home all the way up to maybe $150,000, $200,000 for a really, really nice one. So this is definitely an option for you to explore in your home buying journey. So this is all that I have to offer this afternoon for tips and tools of owning the home buying process. So you should have enough information to kind of get the ball rolling. And right now I will pause for any questions that there may be. All right, so I'm looking here in the chat box, and Jenny has a question about, what if you have been divorced for 14 years? Well, if you have been divorced for 14 years, then you will probably be in a position where you almost have a clean slate. Anything that you may have been dealing with your divorce probably has cleared up anywhere from 7 to 10 years in terms of your credit. So now might be a good time to reach out to your banking professional or your lender and see where you are and get some ideas on what things you might need to work on. I would think that you're probably in a pretty decent position in terms of the past, in terms of what the past you may have endured in the past. So certainly get with your banking professional and take a look at your credit, or even you can do it yourself going to www.annualcreditreport.com. That's an excellent website that we recommend, where you can go and take a look at your credit report and kind of see where you are. All right, Jenny also has another question. She says, would I have to provide the divorce judgment? I will certainly have the divorce judgment on hand for the mortgage lender, so that they will know what types of things were granted or not in that divorce. They may not even ask for it since it's been 14 years, but I will certainly try to have it on hand. And then Jenny also wants to know, what is the income limit for rural development? Well, that is something I don't want to really get into here in this public forum, but I will certainly get with my mortgage department, my mortgage lender, and discuss those things with them, because I want you to get specific information. In this forum, we're just giving general information. All right. I think those are all the questions. If you have any, if anyone else would like to submit a question, you can go ahead and enter it into the chat box. I'd be happy to answer it. And if not, I will turn it back over to Ms. Lauren. Okay. Thank you so much for your time.
We do have one more question.
Oh, I see it. Okay, Ms. Ruby would like to know, would being retired make qualifying for a 30-year mortgage? Could that also require 20% down? Okay, so being retired, I have in my experience, I have seen people of all ages and all retirement stages purchase a home. It still falls back upon the things that we just discussed: your credit, your income, can you afford it, all of that. No one will discriminate against you because you are retired or because you're a certain age. You should be able to qualify just as someone who is in the dead heat of working. So I think that will be fine. And then also the 20% down, it just depends on the type of mortgage that you're looking into, in terms of down payment. Also, make sure you look at a rural development. Don't rule that out. That's something that you could possibly get into for 0% down. So that is my answer to that. Thank you that's a good question. Anyone else?
I see another one. Can 401k be used for the 3 months of mortgage payment?
In some cases, I have seen that happen. However, you want to be very careful with your 401k. I know that some 401ks can be used as a down payment for a mortgage, but you just want to be very careful with that, because remember, your 401k is really set aside for your retirement, and you don't want to dip into that and then not have retirement. So speak with a financial advisor on that and see how they would advise you on the specifics of that situation.
Okay, well, thank you everybody who attended. I hope you learned something, and thank you, Lisa and Pelican State Credit Union.
Thank you.
This has been recorded, so you can go to our YouTube page if you just need a recap or refresher.
Thank you, Lauren.
Okay, thank you, everybody.